Welcome to this explainer. Today, we're jumping straight into one of the most fascinating paradoxes playing out in the market right now. We're looking at Cisco Systems. You know, the massive legacy tech giant that actually once held the title of the most valuable company in the entire world? Well, right now, they find themselves at a really weird crossroads between their latest earnings report and their actual valuation realities. Let's get into it. Check this out. You've got CEO Chuck Robbins stepping up to the plate with absolute confidence, literally declaring a very strong close to a record year. He's looking at this explosive demand for AI infrastructure, and from management's perspective, they are absolutely crushing it. But here's where the story takes a totally wild turn. Immediately following that glowing, super confident earnings release, the stock plunged 8.4%. The market basically took all that good news and just slammed the sell button, creating this massive cognitive dissonance for investors. So you have the CEO taking a victory lap on one side, while the market just pulls the rug right out from under them on the other.
Okay, so we really need to dive into this contradiction. We have to ask the ultimate question that literally every investor and tech watcher is debating right now. Is Cisco a must-own stock that's riding a massive multi-year AI networking supercycle? Or is it a company whose best days are already totally priced into its current valuation? Let's start with the bull case and look right under the hood in Section 1, the engine, the AI supercycle. The sheer scale of the demand here is honestly staggering. We're talking about $9.3 billion booked in AI infrastructure orders for fiscal 2026. And what's even crazier is that $4 billion of that came in the fourth quarter alone. So this isn't just some hypothetical projection down the road. This is pure, undeniable demand materializing right in front of us. When we actually project this momentum forward, the growth expectations are massive. Management is guiding for tremendous expansion, pushing total revenues toward a projected $73.4 billion by fiscal 2027. Chuck Robbins didn't just call this a good quarter, right? He framed this as a multi-year, multi-billion-dollar networking supercycle. It's being driven heavily by data center modernization, and man, those revenue targets really reflect that ambition. And the foundation for this trajectory is incredibly solid. Q4 revenue hit a record $17.25 billion. That's a 17.6% year-over-year growth. And they secured their fifth consecutive earnings per share beat at $1.22. Plus, these orders aren't just coming from the big hyperscalers. Enterprise AI is up 21%, and public sector AI jumped 30%. At its core, Cisco has successfully positioned its Silicon One chips and optics as the absolute backbone for the global AI buildout. Right now, honestly, their narrative is probably the strongest it's been in over a decade. But, as we know, the stock still dropped 8.4%, which brings us to Section 2, the squeeze, margins and the hardware shift. The absolutely crucial point here is understanding why the market panicked despite those record revenue numbers. For years, Wall Street lauded Cisco for successfully transitioning into a recurring revenue model. It was their golden goose. But if you look at the breakdown now, the subscription share of revenue has actually fallen to just 48% from previous highs. Hardware and other revenue is now eating up the majority at 52%. This marks a very distinct structural regression in their business model, and well, it clearly caught the market off guard. What this does is create a completely different investment profile for anyone holding Cisco. On one side, you have software and services. High margins, steady recurring revenue, but virtually flat growth. On the other side, you've got these hardware-heavy AI systems. And yes, they are booming with 24% year-over-year growth, but they are inherently cyclical and, this is key, they carry much lower margins. You're no longer just buying a nice, predictable software stream. You're buying heavily back into a hardware cycle. And this shift toward hardware, it exacted a pretty heavy toll on their profitability metrics. Non-GAAP gross margins dropped down to 66.3%. That's a 210 basis point decline, so essentially a 2.1% drop year over year. When a tech company trades gross margin for scale, especially when they're transitioning back to a hardware-driven cycle, it severely spooks the market. Investors love growth, for sure, but they definitely don't want to see profitability shrink to get it. So, with record revenues battling those shrinking margins, we arrive at Section 3, the jury and the verdict, Wall Street divided.
And Wall Street is absolutely split on this. On one hand, you have HSBC downgrading the stock to a hold with a $120 target. Their reasoning, they see a lack of positive catalysts going forward. They believe the stock is fully valued right now compared to its peers, and they're worried that EPS growth is just going to peak and then moderate. But then, flip to the other side. You've got heavyweights like Morgan Stanley, UBS, and incredibly aggressive targets from Wells Fargo, all the way up at $150. These firms are banking on the fact that the AI business is going to scale massively. They point out that operating margins actually expanded because, well, this AI scale doesn't require massive incremental expenses. So despite the vocal bears who are, deeply concerned about valuation and margin compression, the overall consensus actually still leans bullish. According to S&P Global, the consensus rating is a buy with a $134.77 average price target. To put that in perspective, that projects an upside of over 20% from recent trading levels. The bulls simply look at that post-earnings pullback and see a prime buying opportunity. So, how do you actually make sense of all this conflicting data? That brings us to Section 4, the decoder ring, metrics to watch. Moving forward, you really need to block out the daily noise and focus solely on two vital metrics. First up, gross margin trends. You're basically checking for stabilization here. If Cisco can just stop the bleeding on their margins while they scale this AI hardware, that's a massive win. Second is total ARR, or annual recurring revenue. If margins stabilize and that recurring software revenue stream just keeps chugging along and growing in the background, the bulls are absolutely right. This is highly profitable growth. But on the flip side, if the hardware pressure continues to squeeze margins and ARR growth stalls out, the bears are going to win this argument. We'll leave you with this final provocative thought for today's explainer. As Cisco navigates this monumental transition, literally trading the safety of software margins for the explosive yet cyclical hardware demands of the AI revolution, which side of history will the stock ultimately land on? Will this supercycle carry them to totally new heights, or have we already seen the peak? Keep your eyes on those margins. Thanks so much for joining us for this explainer, and keep learning.